Okay, good morning, everybody. We're going to start the webinar now. This is Richard speaking. Okay, our usual disclaimer. So today we will start off by giving our presentation on the results of the companies under our coverage, and then followed by a macro update. First up, is Soilbuild Business Space REIT. As you can see, gross revenue was up 22%, mainly due to acquisitions. Uh, from KTL Offshore and SpeedyTech, which was acquired in 4Q14, and Techniques, which was acquired in 2Q15. Okay, and then if you look at net property income, it's up 25% year on year. One thing to talk about this is that if you look at it, 25% is the net property income growth is higher than the gross revenue. This is due to the acquisition of properties which are on master leases. So the KTL Offshore, SpeedyTech, and Techniques properties, they are on master leases, and master leases have higher NPI margins. So the year-on-year increase in net property income by 25%, which outpaced the 22% for gross revenue, is not due to any cost cutting or better cost management, but mainly due to the kind of tenancy mix in the portfolio. And then consequently, right at the bottom line, DPU again 5.1% growth. So they have been. This is the lower. When I say lower, I mean lower compared to the gross revenue. This is lower uh, due to um, increase in number of units. But if you look at it historically, Soilbuild has been able to grow their DPU year on year every quarter, and this has been fueled by their acquisition strategy. So moving on to their portfolio occupancy remains high at 98.7%, which is slightly lower quarter on quarter, which was I think 99.8 in the previous quarter. And although occupancy remains high, they have some confirmed non-renewals from their tenants. The two properties to look out for is West Park Bay Central and Tuas Connection. What they have told us is that if there's any decreases in rent, West Park Bay Central will be more affected than Tuas Connection. For Tuas Connection, there's a certain level of tenant stickiness because for this property, the tenants actually do put in some capex to put in things like crane and um, other equipment. So it's not so straightforward that tenants move out. And then going back to West Park East Central, the feedback from the manager is that uh, a lot of their tenants in this particular property are in the logistics sector, and so because of the large amount of warehouse space coming on stream this year and next year, rents for warehouse is a bit more vulnerable, and so that's why they are saying that performance for West Park East Central, if rents come down, it will be more affected than Tuas Connection. And so this also goes to show the benefits of diversification, diversifying different property types and tenants from different trade sectors as well. Going on, second bullet point is well positioned for inorganic growth through acquisition. So for Soilbuild, they have been able to grow their DPU year on year, um, and mainly through acquisition. So now their gearing is quite moderate 36%, and that will give them a debt headroom of 78%, 78 million, 78 million debt headroom, uh, based on a 40% gearing. What to look out for in the next quarter? So we expect to have gross revenue and DPU year-on-year growth again. This continues with the same reason: acquisitions from KTL Offshore, Speedy Tech, and Techniques Offshore. Um, Having said that, one thing that we see for Soilbuild REIT is that they will need to make an acquisition within the next 2 quarters in order to maintain their DPU growth momentum, because these once these acquisitions have contributed to four quarters worth of results, then you get a flat DPU again, all things equal. So to conclude, for Soilbuild REIT, we still have an accumulate rating. What we still like about Soilbuild is that they have access to the niche properties of business park space. So for business park, we see a decentralization of commercial activities outside of the CBD to business parks. And business parks, they are the supply. There will not be any more. There are no planned supply after 2017. This one you can check it out on the JTC website, also you can see it for yourself. No more planned supply for business parks at the moment. So business park rents should remain quite resilient as well, as demand increases and there's no more supply planned at the moment. And so last Friday, Soybean closed at 84 cents, and we maintain our target price of 91 cents.
Okay, good morning guys, Te Hong here. So First REIT announced their 3Q results last week, and let us go through how it did over the last quarter. For third quarter 1.5, you see that revenue came in at 25 million. It's up 6.1%. DPU was up 3% year on year, and the 6.1% up for the gross revenue is driven mainly by the hospital they acquired in December last year, Siloam Sriwijaya, which wouldn't have contributed to the third quarter earnings last year. So primarily driven by this acquisition. And if you look at First REIT, the 9 months results versus what we estimated for the entire year, you see that all of them came in very close to 74%, 75% of our estimates. So one more quarter remaining, that should top it up to around close to what we estimated for the entire full year. Now the thing about First REIT is that if you look at First REIT, it is forecasting their results is actually not complex science, because for First REIT they have all their leases on master leases. That's number one. So when you have all on master leases, annual escalation, right, is all predefined. So it is very easy to predict their revenue going forward. And secondly, if you look at, so revenue side, we have it as very stable, very predictably stable. Cost side, now cost side, what are some of the major costs that the First REIT has? One of the major costs is actually finance costs. And for First REIT, they actually have like 95% of their debts fixed on a fixed rate basis. So on that note, right, you see that revenues, they are very stable and costs are fairly easy to predict as well. So it's not out of surprise that results came in very in line, and I would say predicting this, the results of First REIT is actually not complex science at all. So that being said, I hope what you can interpret from what I said is also that if you are to buy into First REIT, you're looking at a vehicle which is very stable and you have very, very stable incomes for the very long foreseeable future, because all of them are on master leases, which I'll show you next. Look at the hospitals that they own, all long-term master leases, earliest expiration is also only in 2021. And even in 2021, there is another option for the master lessee to renew. Like if you look at Lentor Residence, right, one of the nursing homes they own in Singapore is a very small component of their portfolio. But we see that this additional 10-year option was already exercised last year, and now the expiry is pushed back to 2027. So the point I mentioned just now about revenues being very predictable and very stable, you can see from this table very clearly. All master leases, long-term expiries from 2021, then you start to kick in some of the expiries. Now, one thing that is of concern to us is that if you look at First REIT for the past few years since 2010, they've been doing acquisitions every year. And essentially, First REIT is a growth story because we are banking on the fact that the Indonesian healthcare sector is opening up. There's this universal healthcare insurance that is going to be extended to all citizens and residents by 2019, thereby driving the healthcare demand. And because the sponsor is going on this aggressive expansion in hospital networks, and that will lead to a lot of acquisition potentials for First REIT when the sponsor wants to recycle capital. So you see that in the last 4 years, on average, every year there have been hospitals passed down to First REIT, regardless whether or not most of them are from the sponsor Lipo Group. So every year you see that they do on average maybe about 70 million Sing at least worth of acquisitions. But until now, this year there's things have been pretty quiet on the acquisition front so far. Now we look at capital management update for First REIT as well. I think forex risk and interest rate risks will be two of the key risks that investors will be concerned about. Not a big worry on those two fronts as well, because if you look at debt, 95% of their debt are on fixed rates. And then as for forex risk, all their hospitals are collecting rentals in Sing dollars. So forex risk is really minimal. There's no worrying about the depreciation of the Indonesian rupiah weakening the earnings prospects of the hospitals, because all the rental income for their Indonesian hospitals are in Sing dollars. They have they have a Korean hospital as well, and that one is denominated in US dollar. But that one is a really small percentage of the portfolio. Then if you look at debt maturity profile as well, 95% of fixed interest rate, and not only that, 2017 then we will see the first need for refinancing. So you can really expect interest costs, financing costs for the next 2 years to be relatively stable, which is my point about just now. It's not it's not difficult to predict the first read results at all, and you're looking at a very stable investment vehicle. So with that being said, we maintain our accumulate call on first read. I think last done price was about 137. Our target price is 149. We slightly lowered it from 155 on the back of slower rate of acquisitions that we anticipated when we did the initiation. So we lowered our target price to 149, but nonetheless, we still have an accumulate call on it. So next, I'll pass on to Linson to touch on macro events.
Good morning, everyone. This is this is Lindsay. Your Today I will be touching a bit on some updates from the Asia ex Japan macro. So without further ado, sorry, it, can you hear me clearly? Mic check. Okay. Thank you so much. Yeah. So yep, this is just a brief overview on the Asia ex Japan region. So as you can see from here, these two charts are actually year-to-date return, and you can see that we have been experiencing a global equity market meltdown for the past quarter, starting in July, led by the Chinese equity market. And as you can see from this chart here, that this red box which I've circled out, all the Asia markets are hit badly, and we also see that it coincides with the currency depreciation here. And we know that there are exodus of capital from these few regions as well, in particularly Thailand, Indonesia, as well as Malaysia, which later I will touch a bit more in depth. Just to highlight this Shanghai Shenzhen, this Shenzhen Composite Index. So as you can see that it is by far year to date recording the highest return, and this is actually fueled by the impending Shenzhen Hong Kong Stock Connect, which they will mirror the Shanghai Hong Kong Stock Connect. And this rally might actually follow suit what Shanghai Composite Index had been performing. As you know that they have actually rallied more than 70% since last year, mid of last year, when they announced that they are going to have they are going to kickstart this stock connect, and it jumped from about at least half in November last year. And what happened today? It actually rebound. The market actually corrected to less than 10% return year to date. So we are expecting that this Shenzhen Composite Index might follow suit, and it might create a bubble at the moment, fueled by this Shenzhen Hong Kong Stock Connect hope. So we have summed up to 3 primary concerns for this region: slower global growth, stronger greenback, and rising risk aversion among investors. Okay, on slower global growth, we have actually plotted a chart for the past 5 years, and including the Bloomberg consensus of the Asian region. So from here, you can actually see that India is a lone bright spot. The lone bright spot in the region is projected to overtake the Chinese economy growth by this year exactly. Yeah, when they are actually projecting about 7% growth for fiscal year 2015. As for China, it's going to slow to 7%, and some are actually looking at 6.8% this year. There are a few international organizations have actually revised the GDP growth projections for this year as well as next year. This is the second time revision since June. They've revised it for the past 2 weeks. Yeah, and as you can see that from here, I have highlighted the new GDP growth projections for this year and next year. And for Asian side, and as well as China, you can see that growth is slowing down. But although that for the rest of the world and also US as well, although that they have revised downward, but we can see that the economy is still growing for this year to next year. From that, we can also look into the Purchasing Managers Index, where you give you a gauge of how the economy is performing in the manufacturing sectors as well as the services sector. The greener it is, it indicates a higher expansion, and the darker red will indicate a deeper contraction. So as you can see that the developed markets are actually getting more green as compared to the EMs. So from there, we actually concluded that the weakness persists in the emerging markets, especially in the Asia ex-Japan region, and this is also reflecting sluggish demand domestically as well as externally in the EMs. So with that, we also can conclude that trade remains weak within the region. Okay, going into the respective country. For China, we remain neutral on the back of their commitment to reform and opening up of current account, capital account. As mentioned earlier, the Shenzhen Hong Kong Stock Connect, earlier they have actually said that they are going to launch this Stock Connect by end of this year, but due to the latest market route, they have revised the schedule, and it could be postponed to next year. As for the renminbi inclusion, which has been the hot topic for China in the past few months, as we know that they were not able to make it to the list on the last revision, but they're going to have another round of assessment in November. But our view is that the earliest that renminbi may be included in the SDR, the special drawing rights basket, would be earliest by next year, September 2016, because they are due to firstly, without that IMF would want to add further volatility in the currency market on the back of weak global growth, as well as although that currently equities markets has been stabilizing, without that IMF is going to rock the boat at the moment. And another positive thing that we are looking at is that we are expecting the real economy to rebound and to reflect the previous stimulus measure. There should be more reforms and stimulus package coming from the government. And although that the Chinese government has flip-flopped on its policies, especially in the real estate market, but this revision on their property market policy may actually help to recover their property market as well as to jumpstart the credit cycle. So with all this, we are maintaining our neutral stance. India. So as mentioned earlier, India is the favorite market among the Asia ex-Japan region. So due to their improving fundamentals, where we are seeing continual fiscal consolidation, structural reforms. So this actually will contribute to favorable near-term growth prospects. Although that the land bill as well as the GST bill has yet to be approved, but we are quite positive that in next year we might be seeing some improvement from there. Indonesia. For Indonesia, due to the persistent weakness in commodity prices, and we are not expecting any near-term recovery. So this is actually a bad news for the net export country, like for example, especially Indonesia and Malaysia. With all this, the Indonesian government has actually unveiled 3 stimulus packages on the back of amid this economy slowdown. So they are trying to regain investor confidence, and they have also reshuffled a cabinet in the last quarter. But nonetheless, we are still skeptical on their reform progress, the ability and capacity of Jokowi to push through big projects, for example, infrastructure projects, which they have promised during their elections. But although we are skeptical, but we will continue to monitor for signs of improvement. Hence, to conclude, our view on Indonesia remains as status quo until next year. Thailand. As we know that in early September, last month, so the parliament have actually rejected the first draft of constitution, and the prime minister have actually dismissed the past reform council and reinstate a new 21 member constitution council early this month, so that they can start to redraft the new constitution from scratch. And with all this taken into consideration, we should be expecting elections earliest by June next year, June 2017. So they are going to extend their administration to an additional 1 year as they have promised. And this is actually bad for the economy because this adds to political uncertainty, and it hampers foreign direct investments. It hampers how it actually gives some limitation to investment policies and also foreign trades. So with foreign direct investments being restricted and exports remains weak, we remains negative on the Thai economy. For Malaysia, as we know that there have been quite a big hoo-ha in their politics in relation to their 1MDB, a highly leveraged government-backed fund, state fund. Yeah. So with all this criticism from the media, from the public, from the investors, the government has actually reshuffled their cabinet and also pledged to liquidate assets to avoid a bailout in the state fund. So they are going to they have also used the injected liquidity into the equity market to stem capital outflow via the state funds, and they are committed to maintain its current exchange rate policies. So this should be able to stabilize the currency market at the moment. With all this in mind, there are still quite a lot of political play in Malaysia, and hence we are maintaining our negative view until there are some improvements in their or probably and hopefully there might be some political reform in Malaysia. For Singapore is actually hit by external weak demand as well as a domestic restructuring. So we shall continue to see that the public construction sector to help to support the weak economy, as we see the manufacturing sector continue to contract. And similarly to Indonesia, Thailand, and Malaysia, we are hoping to see some positive policies coming from the new cabinet. And just to touch a bit on the haze problem, where we might be seeing that if there's any prolonged haze issues, this actually could hurt the Singapore economy in relation to hospitality sectors, entertainment sectors, as well as those with outdoor businesses. This could also raise business costs, where disruptions in business travels, as well as health costs. So with all this, we actually concluded our view as neutral on Singapore economy. Okay, to sum up, these are the few catalysts. So the onus will be on the governments to revive the economy via fiscal stimulus, as well as measures to curb capital outflows. And the ongoing structural reforms should be able to improve economy's long-term prospects, particularly in China and India's. And the recently concluded deal on a Trans-Pacific Partnership should be able to help to boost trade and investment flows amid this weakness. Yeah. So these are the few key risks that we have concluded. As mentioned, the slowdown in the region's economic growth, the uncertainties in interest rate hike, as well as the stronger greenback. So this would add more volatility in the equities as well as the currency markets. The persistently low commodities prices, which should be a headwind for Indonesia, Thailand, as well as Malaysia. The prolonged deflationary pressures, which might hamper economic growth in long term, as consumers might refrain from spending. And last but not least, political risk. So to sum up my presentation on Asia X Japan macro, so these are the few upcoming events that you might wish to take note of, particularly on October 23rd, Malaysia's budgets. So we shall be expecting a positive outcome from this budget, and hence this will be translated into a positive outcome in the Malaysian equities stock market. Yep. So we have come to the end of our presentation. Now we are opening up to the floor for any questions. Hi, there's a question on the long-term average stated in the slides. Yes, it's actually referring to the past average, 10 years average, not the projected. And yes, we're actually expecting a subdued stock market in next year, probably if there might be any positive reforms or positive stimulus measures coming out um, from the region itself, that might be able to support the stock market, and barring any external shocks from US market as well as the Eurozone market. Yep. Yes. Early this morning, China has just released their GDP data. So for the past quarter, they have actually expanded 6.9% year on year, and that is actually better than or aligned with what the market is expecting. Um, and yes, industrial production has actually dropped, but in relation to the China A50, uh, China A50 mainly consists of the big companies as well as the SOEs. So with in line expectation GDP growth, we would expect the China A50 to continue to maintain stable or probably a marginal growth, um, rather than uh, being affected by the market sentiment. Okay, yeah, just to touch a bit on Singapore market, as someone mentioned that they have missed out. So yeah, Singapore actually is hit by both external weakness as well as their domestic restructuring. So we'll continue to see the public construction sector to support the big economy, and um, we might be seeing ongoing contraction in the manufacturing sector. Nonetheless, similarly to what we are seeing in Indonesia, Thailand, as well as Malaysia, we are hoping to see some positive policies coming from the new cabinet. And to touch a bit on the haze problem, if this problem is going to prolong further, it could hurt the Singaporean economy, particularly the services sector, the hospitality sectors, those entertainment businesses, those outdoor businesses. It could also raise business costs in terms of where there might be some disruptions in business travels and an increase in healthcare costs. Do you see Singapore market rally up further? With this, I would just like to highlight that Singapore market is actually very highly correlated to external equity market, in particularly the US market as well as the China market. Yeah, so if you are seeing these two big stock markets rallying, these two markets might actually support the upward trend of the Singapore stock market.
Hi guys, Teo Hong here again. There are some questions on REITs. So I'll touch on the first question first for first REIT. What is their current debt level and what currency is it denominated in? Okay, for first REIT, as you can see from the slides earlier on, current gearing is 33%. From now until the MAS guided hit that headroom of 45%, there's still some way to go. And previously, I think I've mentioned this before, previously because they are non-rated REIT, so previously the debt ceiling can only hit 35%. But with the new MAS ruling this year that all REITs must adhere to one common debt ceiling level, which is 45%, that's actually good news for first REIT because they actually now have additional headroom as compared to the previous 35%. And then in terms of the debt, what kind of denomination is it in? Bulk of their debt is in Sing dollars, and that makes sense because firstly, their properties are valued in Sing dollars because the income is in Sing dollars. So when the valuers go down to value the properties, when they use like income discounting method, and when your rents are derived in Sing dollars, naturally the valuers value your hospitals in Sing dollars. So for them to have this kind of asset liability match, it makes sense for them to do bulk of their borrowings in Sing dollars. So you talk about interest rate risk, they are hedged 95%. You talk about forex risk, both in terms of the debt, not much, and in terms of the income, also not much. So that's for first REIT. And another question on more REIT like FCT, whether the dividend is sustainable. Now, I think one thing to note for FCT is that every single year since the IPO, they have been able to grow the DPU. And primarily, we were optimistic on FCT also because it's a more defensive sector of retail spending in that it is a portfolio of suburban malls. So in suburban malls, you see that bulk of your spending will come from all the necessity spending, your shopping at your Watsons, your F&B, your services, as compared to shopping at in Orchard Road kind of or Plaza Sing, Bugis Junction, that kind of more discretionary kind of shopping. So in that sense, I would say FCT should be able to stand out more resiliently even in climates of declining retail sales. We have also noted that in for the past few months this year, we have seen pretty sluggish retail sales. But if you look at FCT's year-on-year retail sales, they're still pretty healthy because a lot of these portfolio tenant sales are actually dependent on how the mall managers are able to drive traffic. So if you are able to be more proactive, if you are able to get in all the all the more popular tenants, for example, it's a win-win because the popular tenants they're able to get to get footfall, and the additional footfall will drive the sales for your neighboring tenants as well. So in instances like this, I think even if they would offer a discount, it would make sense for the malls. But these are all about the mall management, and I think we are seeing in terms of the numbers that are coming out that the tenant sales are still going on pretty healthily. FCT is reporting its full year results, by the way, this Thursday. We will have an analyst briefing with them this Thursday morning. So we'll give you more updates probably by Thursday end or Friday morning. Hi guys, Teh Hong here again. One question on the comparison between Soilbuild and First REIT. Which one is expected to give a better return? I would say based on our projections, if you look at our side table, the expected returns in 1 year after factoring in price appreciation and dividends, we are looking at about the same kind of price returns, all in price returns for both REITs for in 1 year's time. But that being said, I think you're looking at two very different REITs with very different dynamics. Now, First REIT is talking about healthcare in Indonesia, and First REIT they are having like master leases for all their hospitals. Earliest expiration, as I mentioned, is 2021. So that's like you imagine buying like a condo and then you have a tenant who's locked in with you until 2021. Stability is there, but a lot depends on the kind of acquisitions they're able to make going forward as well. Soilbuild Industrial REIT is one of the more volatile REIT sector for industrial space. And Soilbuild, they do have master leases as well, but they have multi-tenanted um, properties as well. So when these renewals take place over the next, like you see over the next 5 years, right? First REIT over the next 5 years, as you can see, is stable, no renewals. But for Soilbuild over the next 5 years, once these kind of reversions, renewals take place, there is a certain amount of risk involved. 4 years down the road, we don't know how the economy is going to perform. So certain amount of risk involved going forward. But then all in pricing in the probability and the kind of probability of the returns and the upsides and the downsides, I would say both should show, according to our projections and our models, about the same kind of returns in a year.
This is Richard speaking. There's this question about. I noticed that you have been covering a lot of REITs in a few sessions. Won't the price drop when interest rate increases next year? Firstly, the coverage on REITs is dependent on staff turnover, so that's why you see we don't have coverage on banking, telco, ONG. Okay, and yeah, so it's not. So the reason is mainly due to staffing issues. That's why we have coverage on REITs. Moving on to the next question is won't prices drop when interest rate increase next year? Okay. I've said this a few times and I'm going to say this again. So rising interest rates is a monetary tool. Is used when the economy improves and is to usually to kind of like combat is a monetary tool. So you see, the recent Fed meeting, they did not raise interest rates because they saw that jobs creation and employment numbers were not good yet, and they took it as a sign that the economy hasn't improved yet. So uh, rising interest rate environment is normally associated with improving economy, a growing economy. And so with a growing economy, usually you would expect to have jobs creation and with industrial output as well. So with industrial output, industrialists will need more space and there'll be demand for industrial space, jobs creation, you have demand for commercial space. And so this would benefit the industrial and the commercial rates. And then going along with better employment and improving salaries, then people want to go on holiday, and that's where the hospitality REITs come into place as well. I have to differentiate between a fixed income instrument and a REIT. They are two totally different things. I know that REITs are always compared with yield, but the thing is that for a fixed income instrument, look at the word, it says fixed. You get the same coupon whether the economy goes well or not. And at the end of it, if it doesn't default, you get your par value. Whereas for REITs, you see you can get growth in DPU. So all this growth comes from acquisition, rental reversion. So you are, by owning a REIT, you are actually able to participate on an upside as well. Obviously, also there is a downside risk. So it's totally different from a fixed income instrument where you get a regular and fixed coupon. For the REITs, it's more dynamic with the improving economy and with greater demand, the managers can command higher rents as well. And so higher rents will translate down to increase in DPU as well. There's a question also on capital DC REIT. Actually, currently we don't have coverage on that. But if you look at it, the fundamental drivers seems to be intact. There's demand for more computing space through e-commerce, from social networking, video sharing, and also for small enterprises who do not have the means to own their own data center, they would have to co-locate at one of these kind of data centers. At the moment, we don't have coverage on Keppel DC REIT, so can't really comment anything more about it, except that the fundamental demand drivers seem to be quite convincing.
Hi guys, De Hong here again. Question on Soilbuild. Soilbuild. Since we are bullish on business park space, isn't Fraser Commercial Trust a better choice? Because at Fraser Commercial Trust, they have this Alexandra Technopark. Now, it's I think, okay, we currently do not have official coverage on Fraser's commercial yet, but some background information as to why it's hard to compare in that sense, because if you look at Fraser's Com, right, they also have 55 Market Street, and they also have one other property in the Singapore CBD area as well. And not only that, they also have two Australian properties which are pretty substantial in their portfolio. So you are talking about a different set of dynamics. Probably NAV now is cheaper than Soybean on valuation basis. Probably also because we have seen the Aussie dollar not performing that well this year as well. And they have two Australian properties in there which could be affected, which I think are already affected. And so there are Singapore property as well, the two Singapore CBD properties, 55 Market Street and one more. That one I can't remember. I'm sorry. Those two add up to about the same valuation as Alexandra Technopark. And then if you talk about those two, then you're exposed to the office demand and supply dynamics as well. Because next year you're going to see a lot of office space come up. So that's a different set of risks again for Fraser's Com. No, we're not saying that Fraser's Com is not a good buy for now because we do not have an official coverage on it. But I just want to present a different kind of background story as to why, if you want to compare the two, then you got to look at, especially for Fraser's Com, their Australian side, the properties as well.
There's a question for comment on Cash Logistics Trust. Cash will be announcing their results on Wednesday, so um, perhaps you may want to defer that question and wait till Wednesday till the results come out. But in the meantime, we did publish a pre-results um, outlook last week. So if you are a client, please log into Poems and download the report. There's a second question. It says, if Soilbuild is acceptable, what about Cash Logistics Trust, which is also an industrial REIT? Uh, the two REITs are different. They have different portfolio. For Cash Logistics Trust, their focus is on owning warehouses. So every single property in their portfolio is warehouse. Whereas for Soilbuild, it's a little bit more diversified. So they have warehouse type and single user factory, and for their latest acquisition, Techniques is actually a seafront kind of like repair yard come depot and with an office and uh, dormitory. So the portfolio mix is between Soilbuild and Cash Logistics is different, and so they would be exposed to different supply demand dynamics within the industrial space as well.
Hi guys, De Hong here again. If there are no further questions, I'll just take one final question before we round it off today. So final question, there's one question on rule changes for business trust in terms of the debt profile. The new MAS guidelines for REITs, the debt ceiling of 45%, this does not apply to business trusts. So with that, we will come to an end for our today's webinar. Thanks for tuning in and see you guys again next week.